Hello friends, welcome to AARDHA. In this video, we will go through introduction through personal finance. First, let's see why personal finance matters. Because without financial knowledge, people faces debt traps and scams, right? Also, people are missing opportunities and are having slower wealth growth. Without proper planning, people are struggling in retirement. And with financial literacy, people will feel secure and confident, right? So financial literacy is gives financial freedom. Now let's see personal finance in Indian context. We all know that in India, in schools, personal finance is not taught, right? But it is essential for every citizen. Also, family protection is important, right? It guards against emergencies and scams. Also, life planning like education, marriage, retirement is necessary. Basic, especially in single income households, it is very much crucial. In AARDHA, we see financial literacy as a fundamental right. It is not a privilege for few people. Basically, there are eight core components of personal finance. Let's see one by one what it is. Income is the first one. It may be salary or business income. Expenses like rent, bills, etc. Savings, investments like mutual funds, PPF, etc. Insurance like life insurance, health insurance. Credit like loans, credit cards, etc. Retirement schemes like EPF, NPS, etc. And tax and sections like ATC, ATD, etc. related to this. We need to master, if not master, have basic and required knowledge about all so that we will be financially well. Now let's see each component one by one. First one is income. It may be salary income, business income, pension, etc. Coming to income, it's better not to rely on one job or one income. It's better to have multiple incomes. Expenses. Expenses may be rent, bills, shopping, etc. These may be fixed or variable. Fixed is like every month you will need to pay rent, right? This is fixed. Whereas shopping, it is variable. Here, expenses need to be controlled. It is must. Coming to savings, savings may be saved in banks as RDs, FDs, etc. See, build at least 3 to 6 months buffer. Start with 10,000. If not possible, start with 5,000 or even as low as 1,000. So it will be like emergency fund. You need to start savings definitely. Now coming to investments, there are various investment opportunities like mutual funds, PP, EPF, equity, gold, etc. Here coming to investments, diversification of portfolio is necessary. Avoid over-reliance on FDs as these give mediocre returns. Now let's see about insurance. Insurance will be life, health, motor, asset insurance. Here, when you are going for insurance, buy pure protection. Don't go for endowment or uh, premium back such plans. Just go for pure protection. Don't go for investment linked schemes like ULIPs, etc. Here, credit. Coming to credit, it may be loans, credit cards, etc. This is useful for growth but risky if misused. If you are having credit card, then you need to close the bill within the required period, right? If you are crossing it, it gives interest as high as 36%. So be careful with the credit. It should be used for growth, not for some other expenses and pleasure. Coming to retirement, EPF, NPS, pension scheme, etc. are available. But here, coming to retirement, beware of missold products. Whenever you are going to any scheme, check or ask what might be the compounded annual growth rate, which is known as CAGR. If it is less than say 12% or 10%, it is not at all advised to take it in the first case. Now, At last, we will also need to know about tax planning. People might think that my CA will file tax. Why I need to know about it, right? When you go for CA at the end of the year, he just optimizes whatever the bills, etc. you give, and whatever tax he can optimize, he will do that. But if you know about various exemptions or various legal, legally acceptable ways to have some tax saving, you can do it from the starting of the year, right? So we need to have some basic tax planning knowledge. Now we'll see what are common financial mistakes to avoid. See, coming to expenses, you need to track. If you are not tracking expenses, then automatically you would face trouble with the savings. See, many people don't have this emergency fund. Emergency fund is very much necessary. For example, in COVID, due to lack of funds, many people suffered, right? If people had some emergency fund of about 6 months, it would help them, right? Also, stop relying on FDs, RDs, etc. as it is missing the growth. You can have some fund as emergency fund in FDs, RDs. That may be okay, but completely having your funds in FDs, RDs will not give you proper growth. Also, don't mix investment and insurance. Insurance is for pure production. Investment, you plan it separately. Plan retirement early. Start as early as possible. Also, measure inflation. People are just seeing what is the compounded annual growth rate or inflation rate. Sorry, rate of interest, right? But they are missing this inflation. Usually, this inflation is around 6 to 7% in India. If you are not calculating this and you are thinking that I am getting 10% in some scheme, that is not good. You are relatively getting only 3%. So, awareness is the first step to avoid these pitfalls. Now, let's see various cautions which are relevant for India. Be careful with the loan apps. Only go with RBI approved apps. Whenever you are entering any scheme, have complete knowledge before it. Also, nomination is not the legal hire. It may give disputes after your death, right? So, if it's better to have will if you don't want disputes after your death. There may be many fake calls like they are pretend like agents, etc. Right? Then don't share OTP CVV. Beware of cyber frauds. Report to 91930 immediately. Now let's see what is 5-step action plan. First of all, start with tracking expenses. Know where money leaks and prevent it. At least have some basic budget. In future lessons, we will see what this budget is and how to do it effectively. At least have 20% as savings, 50% needs, 30% might go to wants. At least having some money in savings will build discipline, right? So start it. Build emergency fund. Start with any small amount, even 1000, is also okay. Target to have 3 to 6 months emergency fund. This prevents debt in crisis. If you don't have this emergency fund, you need to pay high interest rate to get the debt. Get basic insurance. Have health insurance plus term insurance. Have pure insurance. Don't mix insurance with these investments as I said in earlier slides. Learn weekly at least one new concept. Knowledge should compound. Every small step you take today will lead to your financial freedom tomorrow. Now, what are the key takeaways? Learn these 8 components. Avoid common traps. Or know what are all scams going in India and be vigilant. Start small, start now. See, uh, coming to like call to action, what are our new learnings you have, or if you may have any doubts or suggestions, let me know in the comment section. In next topic, we will see what emergency fund is and how to make it and where to save it.